Hello, everyone, and welcome back. Thanks so much for joining Daniel Kemp and I. Dan is the Chief Research and Investment Officer of Morningstar Investments. He joins us to close out 2023 and look forward to 2024. Dan, always a pleasure to have you here. I cannot thank you enough every time we get on one of these meetings to say we all appreciate your perspective. So welcome back. Thanks for being here.
Lou, it is great to be with you and a real privilege to chat to you and your clients. So thanks so much for having me back.
All right. Well, again, the privilege it's a mutual respect kind of thing. So we're going to jump right into it because we have a lot to cover. And as we always promise everyone, no charts or graphs. So you can turn this on and hopefully listening to it or shared it with friends before the new year and you pop champagne and listen to Dan and Lou have a good conversation about bonds and stocks. I mean, who could get enough of that? So let's start with the world of professional investing, because 2023, very interesting year, of course. Recently, markets a swing upward pretty significantly, and that has, we'll say, changed perspective quickly. How are professional investors doing in 2023?
Yeah, Lou, thank you. That's a really good question. As folks on the call may know, we've got a team of investors here at Morningstar that are based around the world, and so they frankly suffer exactly the same challenges with their behaviour that we all do when investing our own money. And so when we think about 22, you're right. There was a period where we had very strong rise in markets. We've seen one of those just recently. We saw terrible sort of price changes in bond markets, and equities fell, and it became very, very gloomy. And what happens when we're in that situation is that we become vulnerable to certain distinctive behavioral biases. And it's not just, as I say, everyone investing their own money that suffers these biases. We all do, professionals. And so a lot of my time is spent trying to help the professionals on my team overcome those biases and make good decisions on behalf of clients. So a good example of that would be that when we are surprised by something, then we have a very predictable response. So and this response can be divided into three different types. So some people, when they're surprised, they want to take action. They immediately want to do things, and that's known as the fight response. And they're the sort of people that if someone sort of taps you on the shoulder unexpectedly, they kind of turn around ready to be really aggressive. So that's the fight response. Other people, when surprised, just want to get away. That's the flight response. They just want to get out of whatever situation has caused that surprise and literally run away. And we see that in investors as well. And then finally, there's a group that when faced with some sort of surprise freezes and again doesn't want to do anything. And that's the least dangerous because at least if you freeze, then you're unlikely to make any mistakes. But for professional investors, it's tough because, of course, we are paid to look after other people's money and take opportunities when they come along. And a lot of the best opportunities come when you have those periods of risk. So as we've gone through this year, we've tried to stop people overreacting to market changes. So typically when stock prices are down, people want to sell or they want to go to cash or they don't want to make any more investments. So we try and stop people doing that. That's the fight response because it normally ends in calamity. You make too many decisions. And equally for the flight response as well, where people just want to cash in their current portfolio. They're so fed up with investment, they don't want to be involved in it anymore. And again, you sometimes have that with professional investors as well. The drawback of doing that, of course, is that once you take your money out of the market, then it's very difficult to time when you put it back in. In reality, most people don't. And so that's what we see in these large rallies, that anyone that professional investors or private investors who took their money out, of course, have probably not got back in, which is why it's so important, whether you're a professional or just someone investing your own money, to not try and time every move, but just be there for the long term.
Well, there you go. And I appreciate that's a beautiful setup for the way that Tranquilli Financial Advisor works with Morningstar and other investment firms. But before I get there, this isn't a chart or graph, but of those three personalities, Dan, can you imagine which one I am?
I didn't want to say.
Yeah, no doubt about it. All right. That's I'm from Jersey. So anyway, so we've had the discussion multiple times. That's part of the reason that you ended up being a regular part of these conversations, and I thank you again so much for it. We have different theories within Tranquilli Financial Advisor, and not all clients have all theories, but the idea that we do have some who do take that flight response, that's okay. That's a part of what we do. But then we have a Morningstar that fights through what we're doing. We don't have anyone who freezes, because if they freeze, there's somebody else's investment firm. Okay, that's all there is to it. But we do have those two different theories and others that work on it. So it's a good opportunity to bring that up right now, because I agree. You do have to fight through it, but there also has to be a bit of, let's say, in my professional opinion, protection along the way for the very important assets that we're working on. So with all that, the Federal Reserve now seems to be all news, all-encompassing news. It covers the bond market, it covers the stock market. Jerome Powell speaks, and things move. So can you, if I could ask you to, please maybe cool that down a little bit for us, and give us how does Morningstar hear it when Jerome Powell comes out and talks about rates? What was the reaction to that we could cut in 2024? So we'll start on the stock side, and then we'll talk a little bit about bonds after that, please.
Yeah, of course, absolutely. So we always see central banks as primarily a source of risk, but therefore a source of opportunity, because, as you say, when Jerome Powell speaks, then the entire market listens, and sometimes they misinterpret what he says, or they misinterpret the information that the Fed provides, and they lurch into some new way of thinking. And so we've seen that over the last couple of years, where we've gone through really what has been a single period of the economy going into the deep freeze because of COVID. And then as it opened up again, all of the supply constraints coupled with the excess savings that people had because they hadn't done anything during the COVID period meant that there was too much demand for the level of surprise. We had this big inflation leap. And then, of course, as everything settles down, we've seen inflation come back down. And so in 20 years' time, people will be looking at this and saying, well, that was quite a normal cycle. Obviously, it was inspired by COVID, but it was a normal cycle. Of course, as you live through it, then every time something new happens, you expect to stay on that path. So every time we saw inflation rise, then people's natural reaction is to assume it would carry on rising, that interest rates would have to carry on rising, and that it wouldn't come to an end. Well, that's not typically how inflation works. And then more recently, we've seen inflation come down, and so the Fed has stated they're going they expect to be reducing interest rates next year. They expect to cut 3 times, which seems pretty aggressive, and they may well do that. But the way that equity investors seem to be interpreting that is to say, right. Well, in that case, the interest rate environment is going to be much easier for companies. They're going to be able to borrow at lower rates. People are not going to be less constrained because their borrowing is going to cost less, their mortgage is going to cost less, and so the economy will grow much more quickly than it is at the moment. That's a simplistic view. I think it's better to say that everyone was really depressed beforehand, and prices were therefore pretty low in stocks compared to where they'd been historically, and so actually we're just seeing a normalization of prices. But what often happens in these situations is that these prices go too far. They're not there yet. They look roughly sort of fairly valued. That's good. But if this rally were to continue, again, supported by this view that inflation and all economic challenges are behind us, then we could see stocks becoming expensive again. But we're seeing a very strong reaction in equity markets, which came off the back of people being quite depressed. But that's okay. In the bond markets, it's really quite annoying, if I'm honest, because
wait. You cannot qualify it if I'm honest. You are always honest here. Okay,
yes.
We demand that. Okay, there's no maybes or coulds. Give us the straight skinny. Okay, that's
yes, of course. So what I mean by that is that it's an odd sort of investor that is disappointed by the sharp price rises we've seen in bonds. But the reason why is that just about a month ago, a little bit more than a month ago, you could buy a 10-year Treasury bond for a yield of about 5%, which was really good value.
Nice.
And so actually, I'd quite like to keep that yield for a long period of time because that's a great base for delivering returns. Whereas now,
sure.
Now they're much more expensive, and so that opportunity then has gone away. There's still decent value, but they're just not as good value as they were about a month ago. So all of that return that you'd hope to come over a series of years kind of came in a lump, and that is likely to be an overreaction. And so again, more likely that we might see some sell-off in bonds coming ahead. But again, don't try and time that. We don't try and time that. We just appreciate that it's not such a good time for bond investors now. It's still a decent time for stock investors, even though we've seen those very sharp moves over the last 6 weeks or so.
Okay, so a couple of things for me there to interject with. A year and a half ago, maybe 2 years ago, maximum, everyone thought Jerome Powell was dumb as a box of rocks, for lack of a technical way of putting it, because they completely misread inflation. They blew the whole thing, and now we're hanging on every word. So again, that shift, your job, my job, is to narrow down those extremes, and let's keep a good conviction for the people that we're working with that have asked us to be the stewards of their wealth. So we have to say lop off the fact that he's dumb as a box of rocks, or that he's the new right-hand person for Warren Buffett, because that's going to be Dan Kemp anyway, right? So we have to keep a focus on calming all of that, the extreme side. And something we didn't talk about this, Dan, beforehand, but I do want to just bring up. And by the way, every time we get on one of these videos, I don't know if you can hear the alarms come by the office. I'm right at a corner in Clinton here, but it seems like there's always somebody unleashed coming down the road as if they're coming here. So anyway, what I really wanted to say right now as part of this is entering 2023, so end of 2022, reading the news, a recession was happening. Okay, that's all there is to it. Like, we were going to be in a recession in 2023. That word was absolutely spread all through the markets and everywhere else. News. If you go all the way back to 2021, paying incredibly high prices for technology stocks. You could do it because they're only going up. They're only going to happen. So we have 21 into 22 technology stocks, 22 into 23. Recession is absolutely happening in 23. Now, moving forward to 2024, we're told the Federal Reserve is going to drop rates multiple times even. Done deal. How do you react to all that, Dan? How do you, as a professional investor with a team of professional investors, again, bring that back a little bit? And before you answer the question, I do want to say I look at things in a very positive manner, but I have to filter out the noisy part of looking at things and to me, these three different elements and the Federal Reserve and perception of them, those are noisy pieces of making decisions that we're trying to be as correct as we possibly can be. We're not always correct, but we're trying to do as well as we can. So how do you filter all that out as a professional investor at Morningstar and to your team?
Yeah, thanks, Lou. I think that's exactly the key question. And the way that we think about it is that the future is not a single thread in front of us. Nobody can accurately predict the future. There's always a range of possible outcomes. And you have to be thinking about that whole range of possible outcomes as much as you can, and not assume that a forecast by an economist or a forecast by a central bank is going to determine what the future is. It's just not that straightforward, sadly. And so as you think about that range of possible outcomes, then the way that we think about it is to try and work out which of those outcomes is more likely, and which of those outcomes are currently reflected in the price of an asset, because that's sometimes where the real opportunities are. Where let's say if the stock market is expecting a recession, then often you can pick up some great value stocks in that environment that are going to incrementally boost your returns over the long term, and it's going to boost them more if there's not actually a recession. Equally, at a time when people are expecting lots of rate cuts, and we're seeing bond prices priced, or bonds rather priced as if those rate cuts are already a reality, then you're going to get some overvaluation in the bond market, and it's going to be less useful as an asset class. So we're always thinking about what could happen, not what people are forecasting what could happen. And the reason we do that is because we're surprised less. Because the less we're surprised, the less we make those mistakes we were talking about at the beginning. So the Fed are as good at forecasting as anyone else, I'm sure. And so that's what they truly believe will happen. But as investors, we have to be aware that a whole range of possible outcomes can occur. And the key is not to interrupt the long-term compounding of your money by trying to do too much, by trying to react to every piece of news or noise, as you said, but trying to overreact means that you interrupt that long-term compounding of people's savings.
Well stated. You have been consistent in that message that we have to, let's say, work through, stick with our knitting, for, again, not putting it in a technical manner, just stick with how it is we do things, knowing that we've seen this movie before and we can work through it. So, Dan, I do want to move over to we promised the projections. We promised to keep it around 20 minutes. We'll be a little bit longer than that. What is the Morningstar? And again, we're not asking you to give returns or anything like that. We want to keep everything compliant so we can send this video out and talk to everybody about it. Looking forward, making those inaccurate predictions, but with a strong set of information in front of you to give that to us. Morningstar's outlook into 2024, based on all factors, not just on the Federal Reserve in the U.S.
Yeah. So as we look at 2024 and beyond, there's a couple of key themes that we see coming through. The first is that some of the more what we call defensive types of companies, like utilities stocks, so your power and water type stocks, they've had a really tough time over the last few years, partly because of what's been happening with interest rates. They look pretty attractively valued now, and so we're seeing opportunities in those type of stocks. We're seeing more opportunities in smaller companies than in large companies, because, as you know, that these 7 big technology stocks, the Magnificent Seven, as they're called, yes, have had this huge run this year, and as they become more dominant in the market, then we're seeing more opportunities elsewhere that people aren't paying so much attention to. So one of the best things you can do as an investor is look in the corners of the markets that other people aren't looking, and we're seeing some good value there. We're seeing some decent value in parts of the market where assets are unloved. So banks, for example. Everyone loves to hate banks at the moment, particularly with what happened with Silicon Valley Bank and the other banks earlier in the year. But again, we're seeing good value there. So the summary from a stock perspective is that there's some good opportunities for active managers. So people who are looking in the corners of markets, there's good opportunities for people who are taking that broadly diversified view, aren't just all in on these 7 stocks, and prices still look pretty attractive there in lots of different niche areas. And normally when the opportunities are in the niches, that's where there's some opportunities for active managers of whatever flavor those active managers are. And then second, as we think about the bond markets, then if this, although they look a bit excited at the moment, they're certainly better value than they were a couple of years ago, and so that still provides a sort of bedrock of return or protection to portfolios. Not as good as it was a month or so ago, but still looks reasonable. And then from an economic perspective, then we would sit in the camp and have sat in the camp for a little while that we don't expect a recession as our base case. And it seems that that's likely to be important because from a consumer perspective, people like you and me, there's this overarching feeling of gloom over the economy. And if that lifts, because as you said, Lou, a recession hasn't come along yet, may not come along. If that lifts, then we can see quite a lot of consumer demand come through, which would be very, very positive for markets. So that's our central case. We don't make decisions based on economics, but that's where the potential upside is. When we think about it from a long-term valuation perspective, there's still plenty of opportunities in equity markets, but they're probably outside those big 7 stocks.
Okay, a couple of things there. The first, looking in the corners, you give me the opportunity to, we'll say, put an Easter egg in this video for clients, and or maybe I should say a Christmas or a Hanukkah present. Okay, in this video, ask me about dogs of the Dow. Okay.
Yes.
The dogs of the Dow theory, which is a good one. So that's a little bit what you're getting at by looking in those corners. And then, of course, the perspective of recession, or I'm sorry, the fact that you do not base your investment decisions upon the economics. That is an important statement and important comment, because you base your investment decisions on the businesses that you're investing in. And that is a theory. And I keep going back to it with clients, and a reminder, different theories in portfolios make a difference, in my professional opinion. Then you and I have spoken about this often, Dan. I dare say that I'm one of the first to ever bring up the idea of different theories in a portfolio, meaning Morningstar's theory is to look at the companies. Maybe other stock pickers do look at the economy. That may be their theory of how to go select security. So we have to work through not only the different options of investing in, but who is using what theory on a client portfolio. So you gave me an opportunity to bring that up, and I appreciate that. So I appreciate that perspective moving forward as well. I think it's a good one. It's I think a bit understated, and a little bit, that's okay right now. Of course, I'm always one that wants to, sing from the top of the roof. I don't punish the public that way by singing, but I do want to champion the cause of here's how we're doing and how things are. But I think a bit of understated approach to things right now. And I'd like your comment on this. My take is to, let's say, touch all parts of the markets. And by all parts of the markets, for a long time, we have not really had to look outside U.S. borders for opportunity. I think at this moment, we do. History says when we get significant increases in interest rates like this, we have to start looking at investments that are not necessarily U.S.-based companies, still in the EU or other good parts of the investing world. But we have to start looking at those areas. And you mentioned bonds. While maybe not the 5% yield, there are buying opportunities within bonds because the price of the bonds has been driven down over the course of the last 12 months. Do you mind commenting on that thinking moving forward?
Yeah, absolutely. So we're very much aligned on seeing opportunities outside the US at the moment. And as we look at companies, then we want to marry the quality of the business. So whether the business is likely to still be delivering good returns to shareholders in 10 or 20 years' time with what you're paying for those assets. And as we look outside the US, then there's good numbers of companies, sometimes in quite unfashionable industries, but nevertheless good companies. In Europe, as you said, the UK has some good opportunities. Germany does. We're seeing a few opportunities in Japan, or less than we had, and even some parts of the emerging world as well. And so certainly there's opportunities outside. Within the bond markets, you're right that we've had those we've had the yield come down recently, so people have seen the prices a little bit higher, but over the longer term we've seen the price come down quite a lot. You remember yields not that long ago were down near zero, so we're a long way from that already. I just always like them to be a little bit higher than where they are at the moment, but they're still much better than they were. The one area, and again, this is just a theory of investing, but the one area that we're concerned about is the corporate bond market, where people can pick up a little bit of extra yield by lending money to companies rather than governments, and in many cases these are very good companies, but the additional yield that you're currently getting, what people call the credit spread, is unusually narrow at the moment. So you're not getting a lot of extra return for taking that risk at a time when one of the outcomes, as we said, is that the economy is weaker than those central forecasts that we were talking about. And so when taking additional risk, you really want to be compensated for that risk. So that's a theory that we have at the moment, that corporate bonds aren't as attractively valued as treasuries. But so there's also areas where we're not seeing value, but certainly there's plenty of areas where we are seeing good long-term opportunities.
Excellent. So to sum that up, we have a lot of work to do, Dan, and we like doing it. So we will, going into 2024. We'll do that work. Dan, about 30 minutes, so we just a little bit over, but we had to. It's just a good conversation. It's always a pleasure. The Chief Research and Investment Officer at Morningstar Investments, Dan Kemp, Happy New Year to you, my friend. Thank you so much for joining us. You'll do it again in 2024?
Of course I will. Happy New Year to you, Lou, and to all of your clients. It's just an absolute pleasure to come and speak to you.
I can't wait for you to meet them in person. How's that? So we'll have to do a barnstorming tour of, I don't know, all of America. I don't even know if we're capable of doing that, but we'll try to figure that out. So, all right, Dan, thanks so much. As always, glad to answer any questions that those watching this have. Please share with friends and family. We're glad to talk with them as well. And we will talk to you in the new year.